But thank you all for coming out this morning. As Delray pointed out, I was named one of the top crowdfunding and Jobs Act attorneys in the country by Forbes, which begged the question, are there a lot of Jobs Act and crowdfunding attorneys in the country? I don't know. At the time I was named that, there weren't. And now, many of you out here that might be attorneys or that work with attorneys, this has become a part of many practices because the law is so dynamic and so exciting, people are starting to use it and see that it actually works. But a quick bit of information. First of all, Delray, this is me. I am one of the top crowdfunding and Jobs Act attorneys. I still wear that suit and hat every now and then. But my last name is pronounced Almerico, which with a name like Wanamaker, I get it. Trust me, it's a common mispronunciation and it doesn't bother me at all. 27 years of experience as an attorney, doing everything to help people start and form businesses and get them funded. And then in 2007, when the housing market kind of died and the banks stopped loaning money to people, I was looking for a way to start helping people get funded and jumped into, when the Jobs Act passed, this Jobs Act market. I'm a columnist for Entrepreneur and I write all of the Jobs Act and crowdfunding stuff for them. And as Delray said, I've been pretty much on every television show or what have you. Quick overview, crowdfunding has turned from a non-existent industry to a billion-dollar industry in the shortest period of time of almost any industry in the history of the world. $7 billion worldwide industry in 2013, $16 billion industry in 2014, and a $34 billion industry last year. And when I say crowdfunding, I use that term generically because it includes things like the Kickstarters and Indiegogos of the world. But all of the Jobs Act to me is considered crowdfunding. It is going out to the crowd, whether it's a crowd of accredited investors, whether it's a crowd of the general public, and still using online methods to raise money, which is something that none of us could really do up until just a couple of years ago. I like to say crowdfunding is kind of a big deal, like on Anchorman, because these are dots that show pretty much every crowdfunding project that's going on around the world. And I also like to note, except in Greenland, which apparently doesn't like crowdfunding for some reason, but I guess you can't, there's not much of a crowd in Greenland, I guess. Quick story about the Jobs Act before I break into the different sections of it, and I'm really going to focus on an overview of Reg A Plus to explain to you some of the details, and then we'll get into it a lot more detailed on the panel. I love telling this story because people always talk about the Jobs Act. There's actually two Jobs Act. There's the Americans with Jobs Act, and then there's the Jobs Act, and they're very often confused. You'll actually see articles in the New York Times where they have a picture of the American Jobs Act logo up there that the White House likes to talk about when they say we're creating all these jobs for people. But the Jobs Act itself that we're talking about is actually the Jumpstart Our Business Startups Act. And that just sounds like exactly what a politician would come up with to call something something. These were 4 different laws, 4 different bills that were pending in front of Congress for 4 totally different ways to open up capital markets. One had to do with traditional IPOs. One had to do with accredited investors. One had to do with fixing Regulation A, and the other one had to do with taking Kickstarter and making it something you could sell equity on. 4 totally separate bills. Some brilliant congressional staffer sat down with everyone and said, if we put these all together and we use the word jobs, everyone's going to vote for it. And they literally made up Jumpstart Our Business Startups Act so they could call this the Jobs Act so people in Congress would think this was all about creating jobs, which it is. Ultimately, if people raise money, put it into companies, it creates jobs. But I just love it. I think it's hilarious that they call it the Jobs Act because literally they couldn't get all these things together until some staffer said, hey, here's a clever way to do it. Let's talk about Title II. Title II is what I call accredited investor crowdfunding. This is more commonly known as 506C, and anyone who's done a private placement, a Regulation D private placement, this is the exact same thing except it's done online. So the difference between it and a normal private placement is not much, but I'm going to talk about some of those things. Number one, what's good about a 506C equity crowdfunding offering is there's no limit on the amount of money you can raise. So if a company wants to raise $100 million, $500 million, or $1 million, They can use this law. You can only go to accredited investors, though, under Title II. You can advertise online and solicit investors. Everyone out here knows and remembers for 80 years, general solicitation was illegal. You could not go out for a private company and generally solicit the public or accredited investors. You couldn't go out and advertise. You couldn't be on Facebook. You couldn't send ads to people. Under Title II, which went into effect in 2013, you're allowed to advertise and market. It's the most affordable of all the Jobs Act provisions to use, and so that's the biggest plus of it. Now, the downside, you can only go to accredited investors. Another downside, there's additional legal requirements over a traditional private placement. They're not a huge amount. One of the most important ones is, all of us know, the know your customer type rules and the things where I'm going to somebody I know and I'm going to give them this PPM and I'm going to have them sign, all the qualifications and things. With this, it's a little different. You're online. You've already solicited people you may not know at all. They're coming to a website or your website or someplace to purchase this stock and to learn more about it. The one thing that is really different between a traditional Regulation D raise and this type of raise is that you have to not only have someone self-accredit and say that they're a accredited investor before they can receive the offer, but then you have to take what the SEC calls reasonable steps to verify that they are an accredited investor. Now, what does reasonable steps mean? The beauty is the SEC actually defined this. They actually set out a whole list of things. If you do these things, you're okay. One of which is you get a letter from their attorney or their accountant or their broker saying they're an accredited investor. It's the simplest thing to do. Once you've got that, you're completely covered under the law when you sell securities under this. Now, there's other ways to do it. You can check tax returns. You can do things like that, things no investor is going to want to do. But it's really not a complicated process to follow it. And the SEC literally has written these rules out saying, do these few things, one of them, and you're okay. Downside to this is, it's hard to raise private money for most young companies. If we're talking about a startup or a company that isn't quite revenue producing yet or is in the early days, private money is not easy to raise. We all know that. Every one of us in this room is, it's difficult to do. But there has been successes with this. People don't realize that in the first 6 months this law was out, so just the first 6 months, there were 900 offerings. These are from the SEC, these numbers. $10 billion was invested in new capital through Title II 506C offerings. Now, sounds like a lot of money, but in the same period of time, almost $1 trillion went through regular Regulation D 506B offerings. So it's a fraction of what's still going on in the private market, but it shows, it's got some legs, and this was in the early days. The next part that I want to talk about is Title III. This is where we're taking Kickstarter or Indiegogo and turning it into crowdfunding online. This is the newest law. October 31st, the SEC finally passed their rules, and this law will go into effect May 16th of 2016, in 3 months. That's the picture of every single person who followed the Jobs Act from the time it was passed in 2012 until October 31st, when the SEC finally, 3 years later, passed the rules. This is a law, by the way, that went into effect within the law, written in the law. SEC must pass these rules within 300 days. Must pass these rules by January 1st, 2013. Now, if any of us had a law that applied to us that said you have to do something by a certain day and we didn't do it, we'd be in jail. We'd be having problems. The SEC is like, we'll get to it whenever we do. And they finally did. So it was passed in October of 2015, goes into effect May 16th, 2016. We're not going to talk too much about it. It's not really what this is about, but I just wanted people to understand what the law is. You can raise up to $1 million on something that the SEC has now created called a funding portal. So all of you who have seen any of the websites out there that people are raising money on, they are not funding portals. That's a new term the SEC has come up with. You have to register with FINRA. You have to follow all kinds of different criteria to do it, but you're only allowed to do this on a funding portal. You cannot do this on your own website. You can't do this on one of the platforms that's out there unless they've registered as a funding portal. And as of 3 days from now, people finally can register as a funding portal. So no one knows there's not a funding portal that's out there yet. The first ones will be filed in 3 days. You can sell to anybody. not just accredited investors. So this is open to the general public to invest. There's no state-by-state blue sky law compliance, so it's not going to be super expensive to use. There is no requirement of audited financial records. This is a big deal for startup companies and young companies. The proposed laws for this were going to require audited financial records. In fact, the law pretty much says you have to have audited financial records if you're raising more than $500,000. And the SEC, trying to make this law workable, did away with that requirement if you're using the law for the first time. So no audited financial requirements, which is a big deal. This is wonderful lawyer legislature language. You're limited as to how much you can invest in these investments. Annual income or net worth less than $100,000, you can invest 5% of the lesser of your annual income or net worth, or $2,000, whichever is more. I love the algorithm we're going to have to create to be able to figure this out with people. It's ridiculous. Annual income or net worth more than $100,000, you can invest up to 10% of your annual income, or net worth, whichever is less, up to $100,000. Don't try and memorize that. The funding platforms will have a button that says, how much is your income? Bing, here's how much you can invest. So it'll be very simple. What's amazing about this law in a very bad way is accredited investors are limited just like anyone from the general public. So if you're an accredited investor and you see something on one of these portals you really like and you want to buy that whole offering out, you can't. It's one of the bad things about the law that they really didn't do very well. So just real quickly, the goods, you can raise up to $1 million from the general public. You can advertise, but there are limitations. The law does say, unlike with Title II, where you can pretty much do whatever you want, as long as it's not misleading, here, you can only basically put up a tombstone and direct people to a site, a funding portal, where they can actually see all of the information, watch the video, and learn about it. It's going to be cheaper than Regulation A+, and we'll talk about that later. Now, the downside to it, these are all or nothing offers. If you go on and do a Title III offering and you say, I need to raise $750,000, and you raise $749,000, all the money goes back to the investors. That's a good thing and a bad thing. It's a good thing because it'll force people to realistically evaluate how much money they need to raise and come up with realistic goals. It's a bad thing because most people don't do that. Yeah, we've learned from the Kickstarters of the world that people go out there and they say, I need $1 million when they really need $100,000. If they don't reach their goal, they don't get the money. It's a good thing for investors too. There are disclosure requirements to the SEC. It may be too expensive for many startups to do because there are going to be legal costs involved. And the stock that's sold here is not liquid. It's much like a private offering where when you sell money in a private offering, you have Rule 144 restrictions and other restrictions on it. This stock is not liquid, and you'll see when we get to Reg A+, that's a big difference because Reg A+, you do have liquid stock. All right, let's talk about what we're here to talk about. Regulation A+. I know there was some talk about this yesterday. I'm going to give a nice overview and talk about some specifics and a few little tips and tricks about it. Let me give you the history of it first for those who don't know. Regulation A has been around forever. All right, Regulation A+ is really still just Regulation A. We call it A+ because we're trying to make it sound better than what it used to be. Regulation A+ was a disaster. It was a law that was very rarely used by people because basically you could only raise up to $5 million. You could go and do this anywhere you wanted to, and you could raise it from the general public, but you had to comply with the blue sky laws of every state that you went to. Why would anyone do that when you could do a Regulation D private placement and have none of those requirements, no review of anything by the SEC beforehand? You could be out raising money the next day. This law was very, very rarely used. In fact, according to the GAO, in 2011, there was only one Reg A offering. In the same time, there were 8,000 Reg D offerings, to give you a perspective. This was fixed in the Jobs Act. This was one of those 4 bills that had to be done, and that's what became Regulation A+, which has 2 different sections. Tier 1, which will be far less used than Tier 2, you're only allowed to raise up to $20 million through what's called a mini IPO, as we call it. Basically, you're online. It looks like a crowdfunding campaign. It looks like you're on Kickstarter. It doesn't look any different at all. There's a video, there's documents, there's everything there. But instead of going, hey, I'll give you $20 and I get a t-shirt and a watch that you're going to make in 6 months, you're buying stock. And the checkout process, very similar to checking out on any type, if you're on Amazon or what have you, except that you're actually going to sign a subscription agreement. and the money's going to be put into escrow. But it's all done behind the scenes. So to the average investor who's doing this, it won't look much different than checking out of any other store or checking out on something on Kickstarter. You can sell to anyone, not just accredited investors. That's very important. The key to Regulation A+ is this is open to anyone. There's no limit under Tier 1 as to the amount a non-accredited investor can invest. So literally, if you're Joe the plumber and you want to put your life savings into one of these, you're allowed to. You still have to comply with state-by-state blue sky laws under Tier 1, and that's why this isn't going to be used very often, but it is going to be used for very specific verticals. For example, if you have a real estate project in Chicago, this is a great thing to do if you just want to have Chicago or Illinois investors. Why go through all the trouble of trying to go through 50 states and market to 50 states for a local real estate project? If you want to open a restaurant here in Atlanta, and you want Atlanta investors and you need $1 million, this is a great way to do it. The only state you have to comply with is Georgia. So it will work for local businesses because you can go to the general public, you can do it online, you can market locally, and it'll be affordable to do it that way. There's no requirement of audited financials here either. So for a real startup to use this on a local basis, it really could work. Tier 2, which is the one we've all heard about where you can raise up to $50 million, is a little bit different. I personally see this as the real savior of the Jobs Act. I think this will work phenomenally for most people, but it's not going to be cheap to do. We'll talk about that. You can sell to anyone, not just accredited investors. You have no state-by-state blue sky law compliance. That's the big key. You can sell your stock to anyone across the country without having to go to any state and apply, go through the process, go through the approval process, deal with state regulators. You can go to all 50 states and sell your stock to the general public. Non-accredited investors are limited to 10% of their income or net worth in each of these offerings. So there is a limit on how much non-accredited investors can invest. That's one of the trade-offs for investor protection that was done by the SEC. And then finally, you do have to have 2 years of audited financials. Let me address the one question that I always get asked, because I get asked this by clients, I get asked this by people that we're running these offerings for. If your company's only been in business for a year, you don't have to have, it's not a, if you don't have 2 years of audited financials, you can't use the law. You have to audit up to 2 years of financials if you've been in business for 2 years. And you have to go through the last calendar year end of your fiscal year. So for right now, anyone who files one of these right now, you would have to have audited financials through the end of 2015, all right? If your company started in May of 2015, you just have to audit May through December 31st, 2015. Good and bad from Regulation A+. The good is obviously you can go to the general public and raise money like you never were allowed to before. You can advertise, you can market, you can put this thing out there, you can get the Goodyear blimp to have it on it. You can do whatever you want to market these things. The stock is immediately liquid, and that's very, very important. Now, for all of us in this room, we know that that doesn't necessarily mean there's a market for it, but the fact is it can be sold. So there will be venture exchanges that are going to come out. We're going to start seeing places for these stocks to be sold, but we're very much in the infancy of this. 2 years, 3 years from now, we will OTC is going to open up a venture exchange. We're going to have places to market these, but the bottom line is right now, without listing it on any exchange, without going to the OTC, one of the bulletin boards or whatever, you can sell this stock to someone if you want to tomorrow after you've bought it. So if you know another private person who would like to buy it, if you have a way of marketing it, if you want to market it through your own website, as long as you're doing it in a careful way, you can sell these stocks. It's far cheaper than an IPO. Most people know to do a true IPO, it costs millions of dollars. Legal fees, compliance fees, all of the things. Far cheaper, but still not inexpensive. It's not all or nothing, and that's very important. So, one of the challenges as an attorney when I have many of these clients is making sure that they're going to be able to take the money that they raise and use it in an appropriate way. You don't want somebody who needs $10 million to buy a plant that they're going to manufacture something in to go out and raise $5 million and then not know what they're going to do with it. So a big part of what I do when I counsel people is sit down and go through the business plan, go through the use of proceeds to make sure that whatever we raise is going to be able to be used so nobody gets in trouble with the SEC or lawsuits or what have you. But you don't have an all or nothing situation. If you need $10 million to open a plant up, you can make a minimum. You can say if we don't raise $10 million, we don't get any of the money. That's allowed, and people do that all the time. But the reality is, if you can say, well, if we raise $1 million, we can do this, and then $2 million, we can do this, and $3 million, we can do this, if you don't get to the $10 million, you can still keep those funds when they're raised. Bad news is it's not for most startups, and again, that doesn't affect everyone in this room, but I speak at a lot of startup type conventions and things, and most startups cannot afford to do this, and I'll get into that in a minute. There are ongoing reporting requirements to the SEC. Unlike when you're a public company where you have to file quarterly reports and a lot of other things, it's a simplified reporting requirement, but there is one report you have to file annually and one semi-annually, so there are ongoing legal and compliance costs. You do become a semi-public company. And by that I mean you're not publicly traded, but your financials are in EDGAR on the SEC. So if someone wants to look at your company and see what's going on, your competitors or what have you, the financial information is right there online. So that prevents some people from using this if they want it to just stay completely private and not have some of their information out there publicly. And it does require the 2 years of audited financials, which is a downside because it's expensive. Audit firms aren't cheap, although one of the things we've been able to do over the last couple of years is find some really, really good CPAs out there, especially if it's a young company that doesn't have a very complicated background, who will do the audits for, I've had audits done for $2,500 for startups, which is phenomenal when you consider, most auditing companies are going to charge you $25,000 to even look at your books. So let's talk about Reg A Plus fun facts. We got about 8 minutes to go here. I'm going to go through these fun facts really quickly. No marketing, good luck, all right? Regulation A Plus, once you get the legal done, once you get the compliance done, once you get the accounting done, it's all about marketing. If you think magically you're going to put this thing online and then Shoeless Joe Jackson's going to walk through a cornfield with a pile of cash for you, it doesn't happen. Crowdfunding, Regulation A Plus is all about marketing. And the first thing I do when I sit down with people after I go through their business plan and decide whether we're going to get involved is I talk to them about marketing. Because if you don't have a marketing plan in place, you're going to fail. Now, let me tell you why. A couple of sobering crowdfunding statistics. Kickstarter, everyone's heard of Kickstarter. Phenomenally successful business. Top 200 sites in the US, 10 million average users a month, more than $2 billion crowdfunded. You would think if you went on Kickstarter, wow, I'm going to raise money. I'm going to be able to do this. This is awesome. It's the most popular site. Less than 5% of campaigns on Kickstarter have raised more than $20,000. Now, what good is $20,000 going to do to any of us in this room for somebody who wants to grow a business? If you want to manufacture some little cool toothbrush that flies through the air and then brushes your teeth and then spits for you, and it costs $20,000, that's great. But that's not a business plan. If the most popular site in the country can't raise more than $20,000 for 95% of the people, it's because of one thing. Nobody uses this for marketing. They just put it on there and assume people are showing up. The ones who do market, though, you'll see it is possible. Even though less than 1% have raised more than $100,000 and less than 0.005% have raised over $1 million, those people have spent money on a marketing budget. I've worked with several companies that do marketing. There's a lot of scammers out there who call themselves crowdfunding consultants. They'll take your money and they'll put out a press release for you and that's it. They don't do anything. But the ones who know how to do the marketing properly, it costs money. I spoke at a Wharton Business School convention with a guy who raised $960,000 on Kickstarter, and he actually went through everything he did to market it. He spent $70,000 to raise $960,000, which was great for him. It was a great return for him, but he had to spend $70,000 to do it. Marketing is really all about a coordinated campaign. And when I talk about marketing, it doesn't always cost money. I've got a client right now, it's a medical group in the Northeast that has 300,000 patients in their medical group. They want to go buy 30 more doctor's offices, and they're going to go to their patients. They're going to send an email that says, we just want to, send us a few bucks, buy a few shares, you're going to own part of your doctor's practice. They don't have to go out and market. They got 300,000 people they can go to with an email. If they get a fraction of those people giving them $1,000, they'll raise the $3 million they need. So it doesn't always cost money, but it does require a marketing plan. Typically, if you don't have that kind of market to go to, there's a pre-launch lead generation plan, outreach to the general media, trying to get some kind of coverage from the newspapers, online media bloggers, marketing to your existing customer database. Having a great video is so important because people that go to these sites, especially when you're talking about the general public, they're used to seeing a short, powerful video that's going to really convey to them what you're all about. And then, of course, using social media. All right, fact number 2, testing the waters. One of the provisions of Regulation A+ is you're allowed to go out and test the waters, basically to see if there's interest in your offering. You can go out, you can start gathering, put your whole offering out there and say, who's interested? Send me your indications of interest. Right in the law, allowed to do this as long as you file your materials with the SEC, you can get away with it. Let me use an example, Elio Motors. So the first Regulation A+ Tier 2 crowdfunding campaign, or Reg A+ campaign that's actually gone through and is almost finished, is a company called Elio Motors. They've built this, it's not really a car, it's more of a 3-wheeled motorcycle / car derivative. And they filed a testing the waters campaign. They went out, they spent $200,000 plus, from what I'm told, on marketing their testing the waters campaign to see how much interest they could indicate. They received $46 million of indicated interest from their $200,000 investment. So people got online, saw what they liked, said, I'll invest, here's how much I'm willing to put in, $46 million. They then started their campaign. They had a goal of $25 million that they filed in their paperwork with the SEC with the ability to oversubscribe up to $30 million. And their campaign is almost over and they've raised $16 million. Last time I heard, it may have changed over the last couple of days. I put these numbers up here to illustrate something. Number one, it illustrates 2 very important points for me. Number one, here's a company that doesn't even have a product yet that used Regulation A+ to raise $16 million, and they were the first ones to do it. So it shows it works. It shows that people will invest. It shows that this can be done. It also shows if you're going to spend $200,000 on marketing, why are you doing it on testing the waters? Now, we all know leads. You get a lead, you get someone who's ready to buy, you want them to buy. 6 months beforehand, if you're telling people, hey, are you interested? And then they say, yes, I'll give you $1,000. Then you go back to them in 6 months. They may not even remember what that was an email 6 months ago. So testing the waters for me, we've run some testing the waters campaigns, and we're running one right now on our website on Bankroll. We don't publish the numbers of what's come in because one of the things we see behind the scenes is the numbers aren't real. We've gotten some Nigerian princes who are willing to put $500,000 into companies that we know, Prince Nigeria at AOL.com is not real. So rather than publishing phony numbers that make everything look good, we've chosen not to do that. But you also do get some real leads. And if you communicate with those leads and follow up with them and keep them informed and let them know what's going on, like you would any other lead in any other business, it can be an effective thing to do. I just personally think that spending marketing money makes a lot more sense when you get to this level, where now I'd rather spend $200,000 to drive people to actually buy than spend $200,000 to tell me in 6 months they might buy. All right. Delray mentioned this, so I'm going to give you 2 specific examples here, and I'm going to try and wrap this up real quickly. Can you combine a Regulation A+ offering with a Regulation D offering? And the answer is yes. And we have one example sitting in the room. Jeremy Kuhn, who presented yesterday with Dot Green, is a great example of this. Dot Green is, I think, a really incredibly cool concept. And what they do is, all of us, and again, you heard this already yesterday, but let me give you my perspective on it. When we all go on GoDaddy because we want to have Firstlookequities.com and Firstlookequities.net, you can buy Firstlookequities.green. It costs more. It's not $7, it's $79 to $99 to buy it. Why? Because they're building a community where that .green extension becomes valuable. General Motors .green, Facebook .green. Those companies will take their sustainable green portions of their business and have it under that .green domain. Why is that important? Those companies pay a huge premium to be able to do this. But everyone else in the world, so everyone in this room decides, I want Kendall Almerico .green, I send .green $99. You tell all your friends, everyone in Atlanta does it, everyone in the United States does it, everyone in the world does it. These can be sold in China, by the way. These can be sold in Europe. These can be sold everywhere. This is a worldwide thing. There's billions of potential customers to buy a $79 to $99, Now, why is this important? They're doing what I think is the way that these two laws should go together in a very, very good way. First, you go out to accredited investors. First, you go out to the smart money. And you say, hey, we're raising money now, but we're doing a Regulation A plus in 3 months. By the way, we hired the top crowdfunding attorney in the country, Regulation A plus. No, I'm just kidding. But the fact is, you tease people with that legally. You explain to them that the paperwork is being filed. And by the way, the valuation in the paperwork where we're going out for the Reg A plus is higher than the valuation you can buy at now. So as an investor, you look at this and you say, okay, I can buy the stock now. It's not liquid. Or I can buy a convertible note now that converts into the stock that they're going to be selling. That stock's going to be liquid. I'm buying it at a $20 million valuation, but they're going out at a $50 million valuation. I just doubled my money on paper. And oh, by the way, I have liquid stock that eventually I could either sell or I could market in some way. So this is how the two things work together. No one's done it yet. I've got several of these that are going on, but Jeremy's here and was kind enough to show up today and talk about how this really does work. I also wanted to show you another one of our clients who they got snowed in New York also, a company called Star Shop. And the only reason I bring them up is they're doing this with a 506B. Jeremy's company .green is doing it with a 506C. What's the difference? They're online. You can buy their stock online. Star Shop wants to keep it private. So they're going to private companies. They're not online with their public, with their private offering, but they will be online with their Reg A plus offering. And Star Shop is I love talking about Star Shop because it's a funny company. It's a mobile app where basically you see celebrities talking about products and you buy celebrity owned or endorsed products. What I love about it is I would never buy anything from a celebrity just because the celebrity endorses it. But the general public does, and that's what's amazing. It's also a collaboration between one of the original sharks on Shark Tank and Sprint, a large publicly, 70th largest company in the United States, owns 25% of this company. So they put it on all of their phones, they distribute it throughout their handsets. The only reason I bring it up is it shows you can have a publicly owned company owning one of these private companies that can still go out and do these types of offerings. All right, it's not cheap. What do we have to do? You have accounting fees, 2 years of audited financials, legal fees. I have seen people charge, looking at all the different filings, between $30,000 at the low end and $300,000 to do the legal work, which I think is absurd. But it is not cheap, and it's very nice for me to be able to say that. One of the things we do on our end is when people are working with us, we find ways to back end the fees so that people can afford to do it, because I want people to have money to market. I want them to be successful. Then when they raise money, I'll worry about getting paid. Compliance, you have to do bad actor checks. Basically, any owner, any director, any 20% shareholder has to undergo a bad actor check. Anti-money laundering, escrow costs, accreditation, all of those things cost money, but it's really usually just a couple $1,000s at most. You do have platform fees. People will charge to use their platform. It's either sometimes a per investor charge, sometimes they charge a percentage of the capital raised if they're using a broker-dealer, and then of course the marketing costs. All right, what's the best news? This is all going to get affordable over time. The reason lawyers, big law firms in New York are charging $300,000 to do the legal work is because they can. No one's done it before, so they get away with it. That's going to go down. Number 5, and this is the end of my presentation. You're in a state where luckily you have wonderful state regulators who actually like these laws and have done a phenomenal job, unlike most of the states in this country with crowdfunding. But most state regulators despise Regulation A+. There was actually a lawsuit filed right after the law came out by the states of Montana and Massachusetts, my favorite state in the country, Massachusetts, I'll tell you why, against the SEC, saying this law is illegal. Now, they tried to get the law stayed, and the federal court said no. They've filed motions to get it thrown out. The court said no, but it is still pending. Every legal expert that you talk to says there's no chance this law is going to succeed. The law is being used, and I hope that Judge Judy gives them the Bart Simpson treatment here, because it's just ridiculous that they're trying to prevent this. So here's my favorite guy. I'm sure if he's watching this right now, he's going to come, next time I'm in Boston and do something. William Galvin, head state securities regulator in Massachusetts. He wrote this to the SEC. We are dismayed and shocked to see that the Regulation A+ proposal includes provisions that preempt the ability of the states to require registration of these new offerings and to review them. Shame on the SEC for this anti-investor proposal. This is a step that puts small retail investors unacceptably at risk. This is before he filed the lawsuit. Now, Mr. Galvin is in a state which, by the way, has a lottery, has casino gambling. You can invest in all the penny stocks in the world you want, but this law is anti-investor. What also happened in Massachusetts? Bingo. December 12th, 1980, Massachusetts is the only state in the country that banned the sale of a stock at $22 per share of a startup company because it was too risky. Here's your Wall Street Journal article. Apple Computer wasn't allowed to be sold to the investors of Massachusetts because it was too risky. Same state. All right, final words. I like to say this, don't try this at home. It's kind of like when you watch one of those TVs, do not try this at home. You do need professionals to be involved in this. There's been a couple of companies that have approached me that have tried to file the paperwork themselves, got into a mess with the SEC, called me up to fix it. The compliance parts, you need to have professionals involved to use Regulation A+. I know that's self-serving to say that, but believe me, you have to have people involved. No one knows how 5 years from now, when there's a template and everyone can follow it, it may be different. But right now, you have to have professionals involved. That's it for me for today. I want to thank all of you. I went a few minutes over and I apologize, but we're going to move into the panel for more specific questions.